Hey everybody, Brent with Core Vision Financial Group coming to you today with another episode in our video series on financial topics. Today I'm going to be joined by Brent Thoman, and we're going to talk about interest rates. You know, the Fed, everybody talks about the Fed raising interest rates. We're going to talk about, some of the impacts of that and how people can evaluate where's the best place to put their money using interest rates in their favor. So please go to our YouTube page and subscribe so you're notified when we post a new video. We've been making these videos for about 3 years now, so we're starting to get, in the mid-30s worth of videos out there, so we're starting to really accumulate a library of topics. So please go to our YouTube page and subscribe so you're notified. So Brent, thanks for joining us today.
Well, thank you for having me today.
You want to give everybody a quick intro of who you are and what you do here at Core Vision?
Sure. My name's Brent Thoman. I'm Core Vision Financial Group partner. Been in the business almost, starting my 25th year. It's something I've enjoyed. I actually followed in my father's footsteps, who did it for almost 50 years. Just really enjoying what we're doing and going to talk about interest rates today.
Yeah, so in today's economic and I'll say market environment, you hear a lot of people talk about 2023 is supposed to be the year of the recession, right? We've been talking about a recession coming in 2023, it seems like, for a long time.
Yes.
And then we're here now, and we're over halfway through the year 2023, and everybody's now saying, okay, we think it's going to be a soft landing. We think, the recession's not going to happen. We think if there's going to be one, it's 2024 now, and start going through all of that. So what I want to talk about today, or what you want to talk about today, is interest rates, right? The Fed's raising interest rates, but what we want to talk about is the positive impact of that on, savings rates.
Yep. So let's talk a little bit about interest rates. Really, since 2007 and 8, we really haven't had any chance to make money, whether it's savings accounts, CDs, or money markets, because of the falling interest rates really since the early 80s. It's been 40 years of declining interest rates. We're now going to go into this last year in 22, the first time we've had a steady increase in interest rates, which unfortunately we probably had to take that pain in the market to realize what's happening now, having higher interest rates in your banks, your CDs, and your money markets. So yeah, it's something that also talked to clients saying, hey, we had to go through the pain, and we've always complained the last 5, 6, 7, 8 years that savings accounts weren't paying anything, CDs weren't paying anything. So we had to go through that pain a little bit last year to finally realize, like before 2008, of actually getting some interest rates on some, let's say, risk-free or much lower risk than what we would have to do in the market.
So normally when you hear people talk about interest rates, they're talking about mortgage interest rates is commonly people are talking about, and everybody's talking about such a bad time to buy a house, mortgage rates are so high, and both, conversations I've had with clients are, this is, historically, it's still a relatively low interest rate.
Yeah.
Our recency bias says, hey, wait, we were just getting 3%, 2 years ago. So yes, it is significantly higher than that. But when you put it in perspective of the historical, it's not, 14%. Or my dad told me the first house he bought was 17% interest. That's super high.
Well, you're correct. Again, talking to clients in the generation above myself and yourself, it's funny listening to them say, my first house was 14, 15, 16%. I can remember getting CDs at 20% or 14%, which just seems outrageous to me. So, but if you go back historically, yeah, interest rates on mortgages are not as high. Anyone under 55, probably I'll say in that range, only knows lower interest rates because since 2008, when they've probably been buying a house at that point in time, they've experienced 7% down to, I think at one time you might have been able to get one for 2.5%. So anyone younger than 55, and I'm in that and you're in that, we think it's really high.
Just barely.
We think it's much higher. Like we're in high interest rates, but really historically not so much. But it still puts a drain on the cost, right? If you're used to 4.5 and now you got to pay 7, that's a much different interest rate on what you're going to have to pay for your mortgage, right? But really, honestly, historically, it's about average or maybe a little below average. But to the younger person, it seems extremely high.
Yeah. I think the first house I bought was 7.25.
Yeah.
So, we're right there about where it was when I bought.
I was right at 7 when I bought in 2007, right before the financial crisis and the mortgage crisis and all that. But I just remember as every other year, it seemed like I was refinancing to get it lower and lower and lower. So yeah, we've been pretty spoiled with low interest rates the last 3 or 4 years, really low. But it's something that most of us have not experienced in the Fed's raising rates on a consistent basis. There might have been a 1/4 or 0.5% raise over a year or 2 year period of time, but not to have 10 interest rates, 10 interest rate raises in like the last year and a half. So it is something new that most people are experiencing for the first time.
All right, so we're going to say that's the con side of interest rates going up. Let's talk about the pro side of interest rates going up.
So let's talk a little bit about interest rates. And when we're talking about that, we have checking and savings accounts. Most people understand what those are. Very liquid. The pros are very liquid, easy to get to. Cons, got interest on it now compared to what the last 5, 6, 7 years were, but not as high as you could get somewhere else. So, but again, the pro is I can just write a check. I can go in and get it. I don't have any waiting periods, anything like that. And then you have money markets, a little bit different animal, and a couple different things about money markets. You have money markets as at a bank that they supply the money market, higher interest rate than checking and savings, but maybe not as high as if you go out to a mutual fund, a larger institution, and buy a money market from them. But now you're looking somewhere in that 5% range, which has not happened again since 2007 and before. So the cons on that, fairly liquid, could be illiquid if they have a run, depending on what's invested inside those money markets. Be very careful. I know in 2007, there was a few that went under in 2008 because they were using subprime mortgages to pay the higher interest rates. So be very careful. Most of the money markets we look at use federal paper, whether it's treasury notes, something within 7 to 15 days coming due. And so con would be you have to sell it to then get it. If you're with a bank money market, a little bit more liquid than if you're with a mutual fund with your advisor, things like that, but still fairly liquid. And the last would be CDs. Again, CDs, a lot of people for many years used that for interest to live off of. And then when 2008 hits and the next, let's say 10, 15 years, you can't because you're less than 1% or less than 2%. It's not beating inflation, right? Especially this last year with 9% and we're still at 4% now. But because of the raise of the interest rates, now you can find 1-year CDs at 5% or a little bit more, depending. FDIC insured on your savings and checkings. FDIC insured on your CDs. Some money markets, if you do it straight through the bank, most of those are going to be FDIC insured too. So a little bit of research will tell you the pros and cons of the FDIC insured. But yeah, we're in a different time period. We took a beating last year in the market, bonds and stocks. So no one was really safe there. But that actually was good on the side of, let's say, the banking channels for CDs. We now have interest rates, and you should be talking to your institutions every so often to see, hey, do you have a higher interest rate? What's your money market rate? Is there a different checking or savings account that will get me a higher interest rate? Right now, you shouldn't be looking at something paying you 0.2% like we had for 3 or 4 years in a row here recently. So a little bit of research and talking to your bank or talking to your advisor. We're in a better area now for, let's say, risk-free to very low-risk investments to actually get some interest rates, which is if you're getting a 5% rate, you're technically beating inflation at this point in time. So it is nice to be in that rate. It just took something we didn't like to see last year with the market, right?
Well, we understand that's how a market works, though, right? It's going to be cyclical. At some point, for years, people said interest rates are too low, right? I mean, when it was under 3, people were like, interest rates are too low. And then this is what happens, right? You get to a point that says spending's out of control. All of this stuff is out of control, and you control that by raising interest rates. But it was so low. To get it to the point to where it had an impact, I mean, you had to have 10 raises.
Yeah, no, you're exactly right. I mean, if money's cheap at 2%, why ever spend your cash not to use the 2%, right, or 3%? But you're exactly right. The raising the interest rate, the feds want to slow down the spending. Housing, obviously, you can see what happened with cost of houses because you can borrow for 3%, so you can buy a bigger house, they can charge more. Now we're in that 7-8% range in mortgage rates. You're starting to see housing slowly come down with the prices and a little bit slower. I mean, it's still pretty big, but it's slowed down compared to what it was 2 years ago. And then same thing with the companies. Raising those rates, those especially growth or tech companies, you've seen them lay off. They're starting not to borrow money. That's what they normally do is to borrow for research and development, continue their growth. When you raise rates that high, they kind of back off. So what the feds are trying to do, what we talked about is soft landing, I guess you want to say, is slow that down without it impacting too heavily on the economy. So far, we've seen the labor market stay pretty strong, which is good. Doesn't mean that it won't have a snowball effect eventually. We'll have a recession at some point in time. It's always funny. People talk about it. Well, we're not in it. We maybe get there, but we won't know until it's over, right? I mean, that's always the thing is we never know we've had a recession until it's over. Then we can talk back and say, oh, here you go. Yeah, but there's always indicators, right?
Yeah, the lagging indicator. You're like, oh, we don't know we went through it until after we've already been through it.
Exactly.
Like, what?
I mean, a recession on average is about every 7 years. So technically, you could have probably said the market was in a market recession last year because it was down 20+%. But the economy right now has held up fairly strong. We hope that continues. The Fed wants it to continue, but at a muted pace, right? That's where they're trying to do that soft landing. They're trying to perfectly, and it's tough because it takes so long for those interest rate raises to take effect. I think companies have done a really good job of hanging on. This last rate, you never know, could be the breaking point for some companies at the end of this year, saying we tried to hold as many people as we could, but now at this point we can't. It's just we don't have this consumer spending as much because, again, with all this cheap money and now it's not cheap, we've got to be very careful. I think there might have been, if you look at some of the numbers, credit card balances have raised at a higher rate. $1 trillion just hit that. I think that was yesterday on the 8th, is what they said, which is the highest it's ever been. I've read some articles about 401k plans that have been taken out of or quit putting into or have lowered their amount. So that's not good things. I think it was just the inflation has killed people. But we didn't want to stop spending because the last 2 or 3 years it was so cheap. And in some of the stuff now that's cost higher, they're having to use more money. Thankfully, for the most part, wages have increased at a pretty good pace the last 2 or 3 years. So I think the Feds are doing the best they can. But if you look historically, they've gone past and had to cut rates quicker probably than they wanted. And that might happen again. We don't know. But the labor market has seemed to help stay strong for right now. And hopefully that continues and that recession gets pushed out a little bit farther and farther. But again, we won't know until we go through it, right? And here's the problem is the market usually leads. So the market may have told us last year recession's coming, but it may be 12 to 18 months from last year before it happens, and then we'll go through it, but the market may be up. People always ask it, well, if we're in a recession, how's the market going up? Well, the market usually told us it was coming, just didn't tell us when it was coming, like how close. So it could be the fact that we're getting ready to go through one. I don't know that. It's just if you look at it, the market usually leads that with the interest rate hikes, recession potentially down the road, and maybe we're already back in for the market part of it being higher than the economy. Like we always said, the market and the economy are two different things. The market always leads in or out, and the economies tell you where you're at right then.
So it is nice to finally be earning some interest on your cash, whether it's in CDs, money markets, or checking and savings traditionally have been a pretty low rate. But like you said, 0.2 or we saw some even under that that were very, very low. And you start talking about, okay, maybe we look at 6-month CDs just to try to get the 1%.
Yeah.
And now money markets are 5.25 or more, and you're like, okay, we gotta maybe pivot, have that conversation with clients that says, hey, we were keeping cash and checking and savings, but now we're missing out on a 5% return. In this money market, potentially it's still pretty liquid. You could still get it in a few days, as opposed to locking up a CD for 6 months, 12 months, or whatever that is. But it is nice to be able to have that conversation now to say, hey, we got this cash bucket over here. Maybe we got to change our, strategy on it just a little bit because we can make 5%.
Yeah, so I've actually had quite a bit of conversation, right, the last 8, 9, 10 months. My conversation has been if you're sitting on money in a savings account, first of all, talk to your banking institution. Can you raise my interest rate? If they say no, say, what are my options? What's the money market? What's your CD? Obviously, you want to keep some emergency cash at all times. But if you're sitting on $15,000, $20,000 plus $1,000, if that's not an emergency, maybe it's $5,000 for the emergency. The rest of it should be making. And I've told them, I was like, if you're making very little on savings, you better be looking at your banking institution for a money market or a portion of it in CDs, or be talking to the other banking institution because you should be getting minimum 4% and higher at this point in time. So I highly encourage people and clients to talk to their banking institutions, talk to their advisor, and ask, like, what are the money market rates? What's the risk to that? What's the CD rates? Things like that. So, yeah, if you're getting less than 4%, you better be looking somewhere else at this point, is my opinion. Right. I appreciate the time, Brent, to sit down and talk about the interest rates. It's something that's in everybody's mind right now. So, again, thank you very much.
All right, again, Brent Thoman, Core Vision Financial Group. Thanks for watching the video today. We appreciate you taking your time and watching the videos. Again, go to our YouTube page and subscribe. We appreciate you taking the time. Thank you again.